Just introducing the folks on the panel then. So we've got Matthew McDermott. Matthew is a managing director with Goldman Sachs, where he co-manages the global liquidity product development and distribution group. Got Paul Barnes next to him. Paul is a managing director in Santander Global Banking to Markets, where he's head of short-term markets. And James next to me. James is managing director with SocGen, where he's the global head of cross-asset secured funding. So good morning, gents. So just turning to that question then, wanted to get your guys' views on the bank's role in this market going forward. There's been quite a lot of talk about, given the regulatory change, are you going to be able to really play a significant part in this market? Will there be disintermediation? Will there be other new entrants that might take your place in that role? So maybe, Paul, if we start with you on that one.
Certainly. Happy to, Crispin. Thank you. I guess it's really a case of change and innovation and adapting to the new way. In a sense, historically, in short-term markets and securities financing, the binding constraint was always RWAs, and to a lesser extent the balance sheet. That is changing completely. The leverage ratio is now the binding constraint on repo markets and on securities financing activities. And to some extent, what we're seeing an ongoing delevering process in the banking sector. That is far from finished. That is certainly not concluded by any stretch of the imagination. What we see today are chief executives and CFOs, certainly in the European geographies. Today we have a 3% metric that we're looking to achieve as a hurdle rate, and actually we are all making plans, our CFOs and CEOs are making plans, if not already, to achieve 4% under very short time frames. So in other words, what we have seen so far is merely a start of the process. What does that mean for banks? Are banks dead in the water? Frankly, no. Does it mean that we have to change our business model? Does it mean that we have to refocus resources? We heard from the previous panel some discussion around forensic analysis of the balance sheet. I can assure you that's going on. It's certainly going on in my business. We're going through the balance sheet with a fine-tooth comb, and what that is going to lead to is a reassessment and a re-evaluation of what a true customer looks like. Because frankly, if you have a customer and their only, or one of their only activities with you is short-date repo transactions, then that is no longer sustainable in terms of return on assets and return on leverage ratio. That is the binding constraint. The price of collateral must change, or there will not be a market to support that activity.
Okay. Matthew?
Yeah, look, I agree with everything that's just been said. I don't think banks are dead in this market. However, I do think their involvement is certainly going to be reduced as the new regulations bite. And kind of contrary to, I guess, what was discussed in the earlier panel, I do think, there will be kind of increased pressure on costs, and you'll definitely see the bid offer widen. But do I think, do I expect there to be new entrants? Most definitely. But I don't think disintermediation on a grand scale will happen, because there's kind of two key things really. I think economies of scale with that kind of netting. And the second point is, I don't think the shadow banks would necessarily want to be categorised as systemically important, and all of the regulatory kind of implications that leads to. So yes, I think there will be some disintermediation, but not on the grand scale that people perhaps think.
Okay, James, any final thoughts?
I agree with my colleagues. Banks aren't dead, but we're going to change our behavior.
Yeah.
But that's natural. It's a natural environment. It's natural for arbitrage. Regulations come in, and we adapt. And that's exactly what's happening. We just happen to have regulations that look like the perfect storm. We have Basel, we have Dodd-Frank, we have Mr. Volcker, EMIR, just goes on and on. The transaction taxes, it's a perfect storm.
Yeah.
But no, it's not that.
Okay. Well, here's a chance to see whether or not the audience agrees. We've got audience participation at this point. Can we get the first question up for voting? So, when you think about the changing regulatory environment, do you see the bank's role in securities lending and financing increasing, staying the same, or decreasing? So let's see if people agree. decreasing. Yeah, I think that's probably fair. So that's a good start. The audience generally agrees, although we do get a few saying it might increase. So there's potentially some business out there for you guys. So turning then to kind of the topic du jour. So if you think about changing balance sheets, RWAs, liquidity costs, what are you seeing in terms of changing trading behaviours in your businesses? And Matthew, get your perspective on that first.
Yeah, sure. I mean, I think it's first, it's worth kind of saying what actually is changing. I think a well-discussed topic is, as banks do comply with the various different regulations, be that the leverage ratio or capital, we are seeing balance sheets reduce, and there is pressure on RWAs as well. The other one, which I think is equally important, is the transparency on costs. As people have undertaken this forensic kind of focus of the balance sheet, there is kind of now a more accurate kind of asset and liability kind of management, so proper allocation of costs. And you're also seeing kind of capital and things like intraday costs be properly allocated to different businesses. And so businesses now really kind of truly understand the cost of their operations, and that obviously has an impact on their kind of business model. And you are slowly, beginning to see that change. So kind of what impact does that have on trading behaviour? From my perspective, on the liability side, there's kind of three key things that we've been very focused on. And these are quite granular. But the first one really is we now tend to have limited appetite to actually source financing from jurisdictions where there's poor netting and collateral enforceability. We're always looking to optimise collateral profiles where we source kind of collateral. And that's a function of that is the fact that we are able to have more transparency in terms of the assets that are currently financed and those that are not. And so by kind of being more targeted, we're just more economically efficient. And it's a very kind of neat way to reduce interest expense. And then I think the third one, which actually consumes an awful lot of time, is just actually going out with more innovative structures to the market. So looking to kind of source, financing through more capital efficient structures. We're looking to obviously, like most banks, look to increase term as we look to comply with LCR and NSFR, and provide, kind of trades with different types of optionality, and also other kind of more vanilla kind of trades like equity, for example, and synthetic is also kind of becoming more prevalent too. And the other point I would raise as well, and I think this is a more holistic market observation, and this is, it does vary between banks in terms of their interpretation of the different regulations and how they transmit incentives down to the different trading desks. So even now you do see different kind of incentives across the street as people kind of interpret the rules and incentivize differently.
Okay. And Paul, just thinking about, some of the regs and any behaviours you're seeing, particularly around kind of reporting dates, any sort of oddities around that?
No, certainly we're seeing quite a good amount of volatility in the price and the flow and activity that surrounds collateral, and in particular that's over reporting dates. And certainly from a UK perspective, if one considers for a moment the amount of government bonds, UK government bonds that are held by the banks and the building societies, that's a significant percentage of the gilt market. But one of the things that has happened as part of that forensic analysis of the balance sheet is that collateral is now held in a different part of the bank. So in other words, what we've seen is a process of the gilt edge market makers across the market becoming far more efficient around the long and short positions that they hold. In other words, minimum collateral, minimum balance sheet exposure, optimise the business. So in actual fact, one has to conclude that actually a very large percentage of those assets are now held in the form of banks' liquid asset buffers. And what you see on a day-to-day basis is just under BAU conditions, banks looking to mobilise that collateral. There's a regulatory requirement to turn over your liquid asset buffer. That's done on a day-to-day basis through repo markets and securities finance markets. But in actual fact, what is happening is those assets are repoed out day to day, and the cash that is produced is left on the central bank reserve account. When it comes to reporting dates, the simple question is, do you really want to repo out your liquid assets, increase your balance sheet, increase your leverage ratio contribution, and to do that for just a few basis points? The simple answer is certainly not. And certainly our board and our senior management teams would not support that. So what we are now seeing is increased volatility, which is a function of this sudden cliff event drop-off before a reporting date and in the run-up to a reporting date where collateral, high-quality liquid collateral, is no longer available technically to the short sellers in the market. And that is driving disproportionate response in the market and perhaps unwanted behaviour.
Yeah, not exactly what the regulators would have liked, I would have thought. And James, I think when we talked about this, you talked about some interesting things in the equity repo market. Any observations there from trading behaviour perspective?
Absolutely. The market came out with some information recently. There was an article that they said that the equity repo market had increased 20% from September of last year to March of this year. Not greatly interesting in itself, but when you look at the durations in which equity repo is trading, it's rather significant. The equity repo market in that 6-month period in durations less than 30 days has increased 10%, but from 1 month to 2 months, it increased almost nearly 50%. From 2 to 3 months, greater than 30%. In greater than 3 months, it was approximately 21%. So what we're seeing is the impact of Basel. This is the LCR ratio at work. We're taking money on a short-term basis, but greater than 35 days. The next question is, how will the market react with NSFR when we start looking at longer-term funding? And that's something at Société Générale we're struggling with today. We're challenged with it, as well as I believe the industry.
Yeah.
Would you say the same?
Absolutely. I mean, I'd say obviously the advocacy is still ongoing with NSFR, but we've certainly seen more opportunities beyond a year in terms of sourcing financing, which has actually been, I guess, kind of a reflection of people's concern in terms of that regulation.
It also calls into practice on how do we measure this, implicating new systems, new processes, because we're talking about the difference between, wholesale and non-wholesale money. And it's complicated. We've seen the role or the functionality of collateral management move from the back office into the front office. So when you're in banks and you're in a dealing room, I can guarantee you most of the good traders, they know their cost of collateral, but they also know what they can get in regards to generating alpha by bringing eligible collateral into the bank. The collateral has become a very important ingredient in this recipe of capital markets.
Yeah, I certainly know from the work that we've been doing with the banks for the last 5 or 6 years, working on collateral optimization, how do you get those different pools from the different product silos into some way of understanding that and getting the pricing through into the front office.
I think an interesting observation in terms of the leverage ratio, balance sheet is obviously the binding constraint, and so, or the leverage ratio is the binding constraint. So cash as a collateral is actually very good because you can actually net down your balance sheet, and that is an efficient way to utilise, cash and reduce your balance sheet through kind of CSAs and repos.
And not only that, you have to contemplate it on a global scale.
Yeah.
Because the collateral moves around the globe. I mean, you have to have the right collateral at the right place at the right time.
Yeah.
Certainly, I agree with comments from our colleagues here, but NSFR is frankly the next challenge for the market. It's the next challenge for securities financing activities, and it's the next challenge for repo markets. And why is that? At the moment, as drafted, currently envisaged, is that a repo transaction with less than 1 year to maturity is going to be weighted as available stable funding identically to unsecured cash. And that, frankly, for me, makes very, very little sense. That is a challenge for the industry. It's a challenge for the market. Fine, depending on the type of collateral used in that repo transaction, would there be a progressive scale? Should there be a progressive scale? Absolutely. Would you rate equity collateral as having the same available stable funding ratio as that of a gilt or a UST bond? Of course not. But actually, this kind of blunt instrument that appears to be coming down the pipe towards us is frankly going to cause huge issues. Again, this is a transition from shorter dated activity. Yes, of course, we all agree that a leverage ratio was and is required. It's a good thing. It brings about good change. It does make the banks safer. But actually, again, we're talking about a blunt instrument. What it's doing is frankly weighting an overnight repo transaction identically to a 5-year repo transaction when RWAs was not the binding constraint. Now, for me, that cannot make any sense. What we're seeing the sector do is we are shutting down short-term markets repo transactions in favour of a smaller amount of lower quality collateral at a far longer duration. And actually, it's the type of collateral that when the next crisis does strike, what we saw historically was that anything that was rated triple B exhibited huge amounts of volatility, and that cannot be safe for the banks or for the market. It makes little sense to me just to weight the two identically.
Yeah, I'd agree. We have a saying, a security is liquid until it's not.
Yeah, that's a pretty good statement.
I thought it was an interesting statistic, actually. I think it was the Risk magazine where they said for the overnight treasury repo, the NSFR will have the impact of increasing costs 5 to 10 times, which I think roughly equated to about 60 to 70 basis points, which obviously has the impact of sort of killing the market.
Okay, so another question that's worth discussing is, as we think about the changing environment and the various trading desks, do we have a perspective on which ones will survive, and do you think their security financing needs will change? James, maybe your perspectives on that?
It's an unfair question whether a desk will survive. Desks will, again, behavior is going to change. We're going to examine, what client business makes sense, what doesn't, what sectors make sense, what don't, in regards to RWA, scarce resources being balance sheet, liquidity, capital. But as well as we're going to look at where we position our businesses as well. We start with Sarbanes-Oxley in the U.S., where businesses left the U.S. for Hong Kong and London. But we're seeing it today with the UK bank tax, the UK bank levy. We're seeing businesses that are leaving London, or businesses that would naturally come to London are not, and going elsewhere. So we're going to change how we behave. We're going to change where we work, how we work. But going back to my earlier points, we're going to be more and more focused on collateral. I mean, it is again, it's the ingredient. And, it's not just a catchphrase, it's the real deal right now.
And maybe, Matthew, are you seeing anything in terms of, some of the desks maybe trying to chase higher yields and therefore putting different demands on the internal resources?
I mean, I think just kind of touching on that last point, I think in terms of the desk that could survive, I think, those that are nimble and can actually adjust to kind of a smaller, more capital efficient model will definitely survive. And I think typically where they have high velocity, so they're in and out and therefore they don't consume too much capital or liquidity costs. I do think, institutions do probably need to address some of the kind of perhaps outdated kind of structural features, for example, indemnification. I think that's something that, does need to be properly priced. You are seeing that more in the market now, as people do assign capital to those, to that contingent liability, but that's something that I think needs to be addressed. And also I think the ALD framework needs to recognise that capital is also kind of a key concern of banks, and so not knowing who your underlying client is until T+1 is not really good from a risk management perspective. In answer to your second question, in terms of kind of higher risk assets, certainly kind of some of the anecdotal feedback I've had is that banks are definitely moving down the capital structure, and they're seeing more appetite to finance lower grade assets, to generate more yield. So yes, I think in answer to that. But I think that's also kind of a byproduct of the leverage ratio, which I don't think has kind of played through yet. But as balance sheets do reduce, you've obviously got to maintain a certain proportion of your balance sheet in HQLA assets, and then to generate kind of reasonable ROA returns, you do need to have kind of probably assets that yield more than you would like, and therefore you are kind of looking to have a slightly kind of asymmetrical balance sheet.
Okay. So we talked a bit about collateral there, and there's been a lot of talk about collateral generally in the industry, about whether or not there's a crisis coming as clearing and new margin rules force out demand. Can we get the next question up to the audience? So I'd like to get people's feedback on this, on whether or not the audience thinks that those rules are going to force up demand and there is a crisis coming. What's people's perspectives in the audience, A, B or C? And then we'll turn to you guys to get some reaction on that. Okay. So, reasonable number there, some impact, and then quite a few people also thinking there is going to be a significant impact, and I think there is some definitely two schools of thought here. So, I mean, I'd just be interested in your guys' perspective as you've been thinking about collateral. Paul, maybe if we start with you.
I'm certainly of the opinion that the impact is going to be significant. I'm not bought into the fact that there is or will be a collateral crisis or a collateral shortage. At the end of the day, we've seen a vast amount of new issuance from governments across the globe. It's not that the collateral is not there. The challenge for the industry, the challenge for the banks and the securities lending arena is really going to be around mobilising that collateral. And the real challenge comes at the point at which, as the regulation changes, as the buy side as well as the sell side is required to put up margin for CCPs, CSAs, we've got ESMA coming towards us pretty rapidly, is how is that collateral going to get mobilised? And frankly, at the point at which the market attempts to do so, possibly in a world where central banks are retracting from quantitative easing, less liquidity day to day in the system, are the banks going to be there? Is there going to be a left-hand side of the price in order to mobilise that collateral? The balance sheet from a bank perspective with a 4% leverage ratio is not going to be there to be able to support that transition or that transformation that the market and the industry needs to make. That will be the challenge in my opinion.
I actually have a slightly different view to that. I think, perhaps as the survey kind of showed, I think it is manageable. I think central clearing has been a very slow and kind of well thought out process, and therefore banks, and other institutions have had time to really reposition themselves. And so I think they do have, a sufficient collateral. So I don't think there will be kind of a scarcity.
We have the benefit of the government being in a lot of debt. James, you think?
I really think the topic is exaggerated. Will there be an impact? Of course there's going to be an impact. Actually, there's already been an impact if you look at the repo markets today. The repo market is approximately $3 trillion in size. But I just said that equity repos increased 20% over the past 6 months. So let's say the equity repo market, just to bomb out of numbers, say 100 bill. But the repo markets haven't changed in that 6 months. So what we've seen is we've seen equities come into the repo market, and we've seen more eligible, like securities, treasuries, and what have you, and government bonds leave the market. There's already been a change, and we've reacted to it. But there's so much breadth and depth in that market. I'm not losing sleep over it.
Okay, that's good to know. So just touching then on the repo market. So, central banks obviously have historically relied upon repo markets as a transmission mechanism for their monetary policy. So, Paul, just wanted to get your thoughts on whether or not that transmission mechanism potentially could break down.
Well, I certainly think it's going to face challenges in the future. The way in which we're transitioning, this again, it comes to the point at which, and the UK appears to be somewhat ahead of the curve in terms of where we stand on an economic basis. We may face that challenge in advance of other jurisdictions or other geographies, and to some extent, what we've seen over the years is a significant reduction in turnover and capacity in unsecured markets. And actually, what I think we are now starting to see, certainly in the fixed income space and at the short end, is a similar behaviour in the repo market. On a day-to-day basis, volumes are decreasing. There is less liquidity in the market, in my opinion. And what we're now starting to find as part of this, forensic analysis of the balance sheet, which we've spoken about a number of times, is, going to Matthew's point around use of central counterparties and CCPs, changes from Basel now mean that the RWA consumption around CCPs, not just the fact that they're no longer zero weighted, but there is penal treatment now for default fund contributions. We've got increased haircuts, we've got increased initial margin, we've got increased costs from the CCP, and actually all of these are proving to be a factor that is actually pushing us away from the short end. And frankly, short-term markets historically used to be, overnight to 1 year. It now looks more like a 6-month to 5-year market will be the short-term markets for tomorrow.
I mean, in terms of scarcity of funding, certainly from my perspective, we're we see kind of an enormous amount of liquidity in the market that's available to us. The challenge we have is in terms of optimising our balance sheet, because like other institutions, we are reducing kind of our balance sheet. So, you know, we're able to be a little bit more selective. So I don't see the liquidity kind of constraint as a problem.
Well, I think we've got other regulators coming in to talk, and it'd be interesting to get their perspective. Yeah. I mean, I get the sense that they're looking to widen their tool set for the implementation of policy and looking to interact with more participants in the market. So I think there must be some recognition that this is a potential risk, right?
Yes, I think what we're seeing though, especially with our banks, is we have these policies and we have these new regulations, and some are in effect, some we're stepping into it, but we're feeling a lot of force from our investors, from analysts, from the media, to behave with the new regulations as if they're in place today. And and this is causing, it's a marathon, and we're treating it like a sprint.
Yep. That's good enough.
Absolutely, regulation is becoming self-fulfilling, and what we're seeing is, if we're all sat here today, the requirement under LCR, for example, today the regulatory requirement is 60%. But actually, if you look at all of the banks, we are largely all above 100%. And actually, it starts because one member of the community states that they're above 100%, or whatever metric, and this will happen with NSFR as it comes towards us. It's happened already with LCR. It's happening in terms of leverage ratio. And as I say, CEOs and CFOs are determined not to stand out from the pack. And for that reason, it's becoming self-fulfilling. Yes, we're incredibly safe. But actually, the downside is that the market is shrinking.
Do you think the regulators would be happy with the way that the banks have responded?
I think this, okay, the way in which I would answer that is to say, if the desire was to have better funded banks, better capitalised banks, with smaller balance sheets, that's been achieved. However, the way in which the market appears to be achieving that smaller balance sheet is now through extending maturity risk. And I'm not sure that, all other factors being equal, that makes sense to me.
Okay. Shall we take some questions? Oh, blimey, that was quick.
Hi, good morning. I was particularly interested in the comments I think you made regarding the mobilisation of collateral. There are many people in this room who represent clients or are clients themselves who hold a lot of high quality assets that could be made available for lending as part of this collateral debate. But inevitably the mobilisation has functions around pricing. Everybody's collateral upgrade trade is somebody else's downgrade trade. I mean, how do you think this market represented in this room needs to think about how they mobilise that collateral? Because I think we'd all accept that, frankly, there's a lot more talk than action in that particular space at the moment. I don't know whether you guys would comment on that.
James, you want to?
Yeah, sure. I think what's getting lost in the conversation, to be honest with you, in the collateral, the upgrade-downgrade trade, is we're too focused on the collateral. The first risk in the collateral trade is actually the credit risk. What is your comfort? What is your comfort? You mentioned price. I ask margin. And then we have to determine the collateral, as well as we have to become more sophisticated in the way that we measure collateral. When you start dealing collateral for collateral, you actually create beta risk. And this is something that has to be examined. And for me, that is the next ratio that we're going to be dealing with.
No, I agree. In terms of that mobilisation, one of the things that we've observed in recent years, and LCR has been the large driver, has been the maturity at which collateral needs to be mobilised. Day in, day out, we have the banking sector looking for longer than 31-day maturity transformation for LCR purposes. But actually, I guess, from a securities finance, from a stock lending perspective, I guess what we all need to be aware of is that maturity will get pushed further down the curve. And the reason it will get pushed further down the curve is because, frankly, with a 31-day liquidity regime, there's very little point in creating a cliff event just beyond that. Because, frankly, if the next crisis does hit, and the vast amount of your liquidity is actually at 32 days notice, that comes down towards you very, very quickly.
Any other questions for the panel?
Actually, Crispin, I'd like to ask a question. So we're hearing a lot about reg today, and reg clearly dominates our thoughts. So one of the things that's very clear to me is that the regulators put a very long observation period in, and there's a reason for that. It's kind of their way of making sure the market can, one, adapt and change, and it also gives the market a voice to respond. Does the panel think that whilst we haven't necessarily moved into an NSFR funding arrangement, and for the audience that's effectively moving your funding arguably out to 1 year, but a lot of banks right now are actually already kind of providing their stats on NSFR compliance, and they're very, very high. Do we feel that whilst the market is mid-cycle of changing, we feel that we've made the majority of changes that are needed to adapt for future regulatory impacts?
I mean, specifically answering the NSFR ratio, I mean, I think there's probably a lot of work. I mean, I know JP Morgan came out and said that they were broadly compliant. You know, I know from our perspective, there's certainly work to be done, you know, in terms of our balance sheet, in terms of, you know, particularly, specifically the liability side to be compliant. I think with some of the others that have been kind of firmed up earlier on, we're kind of, I think, you know, to your point earlier, you know, we are ahead of the game, and so I think, you know, most banks are becoming more compliant earlier on. So, in short, I think there is work to be done, but I think a lot of it has, you know, is in process or being done.
Okay, do we have any more questions at this point? Okay, with that in mind, I'm going to say thank you very much to the panel. They've done a great job, so thank you very much. Thank you, guys.